Fibonacci and position trades examples. Now we've seen a number of examples of Fibonacci applied to primarily 1 hour and 2 hour charts. And as you know, you can expand your charts into 30-minute or 15-minute time frames, or narrow them into 2 hour or 4 hour time frames, or you can compress them or expand them. But what I want to do is give you a bit of an idea as to how to apply Fibonacci tool and what to look for particular position trades, because position trades will only come by as relatively infrequently. For real solid position trades, it's relatively infrequent that they present themselves. Much like, depending on how you trade, much like intraday trades. I mean, they can come by at some frequency, but it varies. Sometimes they come when the market environment is volatile and showing good volatility. Then we can see quite a few trades come up through the period of a week, or we can go some weeks where no trades come up at all. At least the way I trade, anyway. We're going to look at the euro, the pound, and the Swiss franc trade against the U.S. dollars, and we're going to look at just sort of how this one particular trade had presented itself in the market, and it was something that I'd been waiting for a long time. And you can just read through this because I'm going to be talking about it, but you can you've got the dialogue for your reference in any event. This is obviously after the fact, like all of our still shots are. But what I'm going to do is I'm going to show you sort of the thought process behind how this trade was made. And these come up, again, relatively infrequently, but when they do present themselves, they can pay very, very, very generously. Now, we had a substantial move in U.S. dollar liquidation, or U.S. dollar selling, from 2002, 2003 to 2004, and price rallied all the way up to just above 136 euro to dollar. And we saw this high form, and in and of itself there was a very, very distinctive reversal pattern before this fall. But as price was falling, not considering the multitude of trades that could have been made during this scenario, what happened was as price was falling, I was waiting for a more profound reversal formation to present itself, and we had a situation. Ultimately, the fundamental drivers behind this whole scenario was, of course, the you've got the double deficit scenario, the war scenario, the instability in the U.S., the capital outflows, the massive personal debt, the speculation of a real estate bubble, and so forth, and considerable amount of U.S. dollar selling. The euro was rallying disproportionately, and then what happened was literally on roughly January the 1st, or between Christmas and January 1, what happened was the market decided that this was going to be the year of the interest rate hikes in the U.S. region. The treasuries markets began to price in interest rate hikes, and so did the currency. And typically, currency flows will gravitate towards the currencies that are the carry trade will move towards currencies that are typically going to increase in value against other currencies, and as well pay a higher overnight rate. And we started to see U.S. dollar buying against most of the other majors, with the exception of the Canadian dollar, for reasons that I mentioned sooner, and that was because of the oil-driven markets and the commodity prices, and all of the inflows into Canada and Canadian dollars around the oil industry and the precious metals, and some other commodities as well. And what happened as a result, we started to see this U.S. dollar buying. In combination with that, if you look at the Eurozone is not all that economically healthy. And on the 1st of January 2005, it wasn't healthy then either, in comparison to the U.S. But the U.S. is more or less the worst of the two. And in my understanding, the euro was well overpriced in comparison to the US dollar, or in relation to the US dollar. And we started to see a squaring of positions and a selling of US dollar. As you see this down leg here, we also at the beginning January of 2005 in this case, and this can happen at any time, 2007, 2008, it doesn't matter. I'm just taking this as an example. And this can repeat itself in years to come. In January, in Q1 of 2005, what we saw was we started to see a string of short-term data that showed a healthy economy in the US, and in combination with that, we started to see a string of short-term data in the Eurozone that was negative. So the combination of the two, in addition to the fact that it was the speculative year of a year of raising interest rates in the U.S., then capital flows and money flows started to move into U.S. dollars, or we started to see U.S. dollar buying against the other currencies. So here's our buying move, or a decline in the euro dollar. As this decline was moving, I kept thinking to myself, well, we need to see the retest. And for me, ultimately, if you can, certainly there was opportunity here, but I was waiting for price to come up and retest these highs and either come all the way up to the highs or come to a distinct Fibonacci retracement level. Now, this fall here moved quite a bit and a lot further than I would have wanted it to move. It moved 800 pips and more, almost 900 pips, which was more than I really would have liked, because that takes away from the following the second down leg. You remember what I said about the second down leg? When this base was finally formed, we started to see the retracement, and I kept thinking I need a deep retracement here in order to see this second down leg. And if you look at the US dollar index, it was also very supportive of this retracement as well. And we see the retracement came up to the 38% retracement, and look how narrowly it held to this level, and really there was no response to it. I was not anticipating a bounce at the 38% retracement because I feel more vulnerable at this 38% retracement, but we saw price rally right through the 50%, and then we saw it come all the way back. You see here how resistance provided support to the market. This, in fact, this whole swing like this was a 38% retracement before its leg up. It started its initial leg up, and you see the fast this was, and the faster it moves, the more I like it. And it moved very quickly, straight through 62%, all the way up to 79%, which is equivalent to the left shoulder here. And it parked itself right at the 79% retracement, and I thought, okay, here we are, baby. We need this 79% retracement to hold. But do you think it's going to hold in the manner at which you pre-plan? No, it's not. It's going to hold, or it's going to move in a manner that it decides. And you have to be flexible and discerning, and you just have to be open and submissive to what the market is offering. Now, before I tell you about how I went through trading this scenario, let me show you what else was happening. Because I didn't just simply open up my daily euro chart every day. Of course, I was watching the intraday trades and trading on an intraday level while watching the senior charts. But let's have a look at what else was happening. When we go to the Swiss franc, we see here that price made a low point here. Look at how on 2 consecutive days the market failed to hold below this distinct low and then move into a gross rally here. Price retraces to the previous level of resistance, now support, and takes its next leg up. This was the US dollar buying that occurred in early 2005, and then we started to say, okay, where's our retest, or where's our retracement that's going to bring us into a buying scenario? Price comes all the way back. Resistance becomes support. Look at the 116 level, how distinct it is all across the board. We see a nice bounce here. Support becomes resistance, and price moves downwards. At the same time that the euro was at the 79% retracement, so was the Swiss franc. and it tested it here for 2 to 3 days. On the third day it released, and then of course we came back for a retest of the retest. But let me show you what else was happening. On what chart? On the British pound. Here was our high. You see the rejection of the high here, and price retraces, and another rejection of the high. British pound will do that to you. It'll try to shake you loose. It moves into this consolidation or this pennant formation, and then we see our retracement. We have a double bottom retracement here. Price comes down, tries to move lower, just as did the euro and the Swiss franc, before beginning its retracement up to the 79% retracement. So now we have three currencies resting at the 79% retracement. However, there are some discrete differences between the two. Look at here how price holds tight to the 79% retracement. It consolidates and casts doubt on whether or not this 79 is going to hold. You see how it released here and then came all the way back, almost all the way back to the 79% retracement, casting doubt on your trade. Because I had entered this trade right up here. I entered that sucker as close to the 79% retracement as I could. Price fell. I took some profit. Still had a large position open. It came up, stopped me out because I moved my stop down below my entry. Should have kept it above. Then I got stopped out and had to re-enter. But look what happened. I want to show you a very discrete characteristic of what happened. You see this deep retracement on the British pound? Well, let's go back to the euro chart. Look at the retracement on the euro chart. It did not come back as deep. This one came back 79% of this downswing. Came back 79%. But let's go to the British pound. This came back deeper than the 79%. It actually came back 86%. It came back a lot deeper, which can cast doubt on your trade. Another reason why I was long the Swiss franc, but I was short the pound. But one of the reasons why I'm short the pound, or was short the pound at the time, is because you see this fast move here. The pound can move pip for pip because the ranges are a lot larger on the pound. Pip for pip, I'm going to get a bigger move on the pound than I would on the euro. Pound comes down here to the 200-day moving average, forms a hammer, and then retraces. Consolidates into a pennant with the base defined by the 200-day moving average, and this here, a very distinct trend line coming down, defining this pennant. This retracement here is a 79% retracement of this swing before it breaks down and continues further. So what I want to show you here is how you want to use your Fibonacci levels as key levels on the larger time frames here, for example, on the daily chart, because the market will highly respect these levels, as there is a more global watch on Fibonacci levels on the daily charts for more or less for those who are trading more or less managing their assets in and around the daily movements of currencies rather than the intraday movements of currencies as we the speculators do. But as a speculator, you should be trading on an intraday level as well as on a medium and longer term, because these longer term trades, like in 2005, the US dollar trended very nicely, and personally I made more money on the longer term position trades than I did in the combination of all of the intraday trades throughout the course of that year. Now I want to point out that as the euro retraced from this level, you see how it formed this double bottom here, and you see this retracement right here. Please note that this was a key level of support, which later became resistance, and then continued. You see here, this is the second leg, and this is the second leg of the second leg. All right, for you Elliott wave theorists out there. And then we see, of course, a multitude of legs in addition, creating our trend, moving it all the way down to 119. A generous move indeed, but I also wanted to show you how we're tying in all of the factors. We tie in the fundamentals with the technicals, and when you're able to have a handle and a feel for the fundamentals as defined in the global economics module, and to be able to combine those with the technicals, then you will have more opportunities to get into some very, very good trades. So again, we see all at the same time the Eurozone, the euro created this high versus the US dollar, a, uh, a generous fall, and then a nice deep retracement to 79% before price continued down. We see it here on the Swiss franc. This is the US dollar rallying against the Swiss franc, a deep retracement to 79%, followed by another upswing, and the second leg of the second leg being a very substantial move indeed. The British pound, a little bit more resistance to give it up, but we see price make this low at this level of resistance, comes down, makes a double bottom low at the 200-day moving average, retraces, and forms. This is a real, like this was, if you think about it, because I started trading this thing right when it hit the 79% retracement. It double topped on the 79% retracement on the smaller time frames, but look, following that double top, it took 1, 2, 3, 4, 5, 6, 7, 8, 9 days before it finally released. And if you're going to get in these position trades, you need to anticipate that it could take considerable time before your trade comes to fruition, and you will have to sit on that trade. And the idea is to simply trust in your tools. And if you trust your tools, money will be deposited in the account. All right, just follow the rules of your tools and manage your trades effectively, and the money will be deposited in the account. Will the market bounce at a Fibonacci number? Well, how do I know if the market will bounce at a Fibonacci number? Well, the Fibonacci's can be a self-fulfilling prophecy, but for me, they have not only been a self-fulfilling prophecy, but they have also been an account and bank account fulfilling prophecy, which is supportive of its tools' effectiveness in the market. So kindly read through this section. Your Fibonacci tool is used to help you identify levels of support and resistance and visible levels of support and resistance, and you look for it to align with other key levels and other key factors and key components as we've drawn out here in both the theoretical charts that we've displayed, but also in the simulated trade scenarios. To exercise the use of your tool, simply scroll through the charts and use your tool to study price action, and just simply and I'm going to walk through how you should be doing that in a simulated scenario. Please get some exercise and consistently use your Fib tool in the live market scenario, because that will really help you to get the feel for it, but also because the old data, if you're just scrolling through 1 hour charts, you may not see a lot of the bounces that occurred at the Fibonacci levels, because on a 1 hour chart all of the candles will already have been closed, and you will not be able to identify how the price has interacted with Fibonacci levels at specific times. So if you don't follow me, I'm going to walk you through that when we go through the simulated scenarios. But the best way to get a feel for your Fibonacci tool is to simply scroll through charts over and over and over again. Trading Fibonacci, use your Fibonacci retracement and extension tool on all time frames. I am less likely to use them on the 15-minute charts and lower. The 60-minute chart, once again, is a good reference for the current trend. Fibonacci is not an exact science, nor is it a holy grail, folks. Use your Fib tools to determine hidden levels of support and resistance that converge with other levels, as determined by your other tools. Your best tool in the market is what? It is understanding the market itself and all of the constituents of the market itself. We want to look for convergences with all of our other factors. We want to look for convergences on different swing levels and time frames. Practice, practice, practice. Become familiar with how the market moves in a Fib sequence on all of your different time frames, and apply your tools and so forth. This will get you acquainted with the Fibonacci tool, and then its application really after a very short period of time will become second nature. Here are a list of Fib trading tips for you to walk through. And again, we're looking for price to test or turn or bounce at specific retracement price levels which offer support and resistance. The extension levels are viewed differently. We look for more exact bounces at the retracement levels versus the extension levels. The extensions are more an exhaustion level area. Um, Fibonacci bounces on the larger time frames, they may be tougher to trade in an exact science, but typically we will find that price will move far more generously on the larger time frames than on the smaller time frames, just as though we're applying any other tool. And if you go back to your lesson on support and resistance, we see how we find these micro levels on very small time frames and fractal movements on smaller time frames that move within consolidative sections on larger time frames. A side note, the pound dollar and the Aussie dollar like the 50% retracement level for some reason. I don't know why, but it does. The more shallow the retracement level, the faster the market is moving. So if price comes down to the 38% retracement after maybe a key reversal day, then the bounce is typically that second ensuing leg can be quite generous. If it's bouncing at the 79% retracement, the swing is typically slower or the market is slowing down. We will also learn how to use the Fibonacci retracement levels to manage our trail stop levels on current live positions as well. This is just a slide that shows you how you can input your parameters on the Fibonacci Trader software. Tell them Chris Laurie sent you. And I will go through this again when I walk through the exercise on how to apply your Fibonacci tool on the charts. But there is a parameters window where we will place in our parameters, and we have to trick the software on the extension levels by putting in minus signs. And in your parameters window, you would put in the following figures in order to establish the proper parameters for your Fibonacci tool when using this particular software. But it'll also give you a feel for your own software, whatever software it is that you're using, and how the parameters window can be used.